All right, buckle up because on the deep dive today, we're going to really cut through the noise around gold. For years, it's been, seen as that traditional safe haven, a simple hedge. But what if everything we thought we knew about its role in a portfolio, well, what if it's fundamentally shifted for 2025?
That really is the core question, isn't it? We're genuinely looking at like a new paradigm here. The old arguments against gold,
Mhm.
it doesn't offer yield, it's too sensitive to interest rates, they're just being overshadowed now. Our assessment, it's pretty clear. It's shifted from just a tactical hedge to more of a strategic necessity for keeping portfolios resilient.
Okay, strategic necessity. So, what's the most immediate kind of striking evidence? I keep hearing about this new price regime. What are the numbers actually telling us?
Yeah, the price action is definitely where you see it most clearly.
Hmm.
Gold's performance has been, well, remarkable. It's been sustaining levels way above $3,300 an ounce. We even hit that record high, remember, $3,424.41 back on April 21st, 2025.
Wow, April 21st? That's
Yeah.
really.
And what's really stunning is you have major institutions like State Street explicitly saying $3,000 is the new $2,000. We're talking about, what, roughly a 27% gain just year to date?
27%?
And it's not just a U.S. dollar story either. It's setting records globally in euro, pound, yen terms, too.
Okay, that's powerful validation right there. You mentioned old arguments and this new paradigm. What exactly is breaking down in how gold usually behaves and what's sort of driving it now instead?
Well, what's fascinating really is the breakdown of those old correlations.
Mm.
Gold used to move pretty reliably, inversely to U.S. real yields and the dollar. But that link, it's demonstrably decoupled.
Decouple, okay.
Yeah. And if you connect that to the bigger picture, it looks like the price is now being set, or at least heavily influenced, by a whole new class of buyer,
Who's that?
global central banks.
Yeah.
Their reasons for buying are just fundamentally different from, say, your typical ETF investor.
Right, the central banks. Okay, so they're a huge piece of this puzzle, but what else is feeding into this unprecedented rally? What are the main drivers coming together?
It's really a powerful confluence, a perfect storm almost. First, you've got profound geopolitical instability and U.S. policy uncertainty. Think about the proposed Liberation Day tariffs announced in April 2025 after Trump returned. That 10% baseline fee.
Right, I remember that causing waves.
Exactly. It acted as a major catalyst, a global flight to safety. Plus, you still have ongoing conflicts, Ukraine, the Middle East, just adding to the overall jitters.
And that connects right back to the central banks you mentioned. What's the scale of this buying? Why are they accumulating so much?
It's truly historic. Central banks have been buying gold relentlessly for 16 years straight now. They added over 1,000 tons in 2024 alone. That's the third year in a row over that level.
1,000 tons again.
Yeah, and JP Morgan thinks they'll add another 900 tons in 2025. Look, this isn't just about diversification anymore. It's seen as a direct response to the weaponization of the U.S. dollar.
Like freezing Russia's reserves.
Precisely. That sent a signal. So there's a deep desire to reduce reliance on any single currency. China's a big buyer, India too. The Reserve Bank of India now holds 880 tons. That's over 12% of their reserves.
Wow. So, okay, geopolitics, central banks. What about the broader economy? Is stagflation still a worry? And global debt?
Oh, absolutely. Those macroeconomic pressures are very much in play. There's a real risk of stagflation. Global growth is slowing, projected maybe 2.3% in 2025. But inflation is sticky. OECD's thinking 4.2%.
Oof. Slow growth, high inflation.
Exactly. And then layer on top this unprecedented global debt. It hit $324 trillion in the first quarter of 2025. All that debt inherently weakens confidence in fiat currencies, right?
Yeah.
It makes gold, something tangible with no counterparty risk, much more appealing as a stable store of value.
Okay, so with all that going on, how does gold actually stack up against other assets right now, like equities, bonds, even Bitcoin?
Yeah, good question. Gold has demonstrably outperformed. It's really asserted its safe haven role against equities. That roughly 27% year-to-date gain we talked about, it blows away the S&P 500's, 8.2%? Especially with the big tech names, the Magnificent Seven, kind of underperforming lately.
And bonds, the traditional haven?
Well, the traditional 60/40 portfolio is really being challenged. Bonds just haven't provided that robust downside protection. U.S. 10-year yields have been all over the place, total returns under 3%. Gold offers near zero correlation there, which is valuable.
Okay, so better than stocks, better than bonds in this climate. What about crypto? Bitcoin, wasn't that supposed to be the new digital gold?
Yeah. Well, the 2025 market really proved gold as the, let's say, undisputed physical safe haven. Gold ETFs returned about 24.4%, Bitcoin ETFs, more like 14.5%. But more critically, during that tariff panic in April 2025 we mentioned, Bitcoin didn't act like a safe haven at all. Gold soared. And let's be blunt, central banks are buying gold, truckloads of it. They're not buying Bitcoin.
That's a very clear distinction. Okay, so even with all this strength, these powerful drivers, are there downsides? Is there a bear case? How solid is this new price floor people talk about?
Sure, there's always a bear case. You can imagine maybe geopolitical tensions easing significantly or central banks suddenly getting much more hawkish than expected. But, even in those scenarios, most analysts see a pretty solid floor for gold prices, somewhere around $2,700 to $3,100 an ounce.
Which is still historically very high.
Exactly. It suggests the market's new structure, this new regime, has real integrity. It's not just froth.
So, wrapping this all up, what does this mean for you, the listener, and your portfolio right now? If gold isn't just that tactical hedge anymore, what's the actionable takeaway?
Based on everything we're seeing, this deep dive suggests a strategic allocation to gold of maybe 10-15% within a diversified portfolio makes sense now. That's definitely an increase from the traditional, say, 5-10%. It reflects gold's sort of enhanced role as an essential hedge against a whole expanded range of risks we face today.
And if you're looking to actually add that allocation, what are the main ones to get involved?
You've got a few main options. Physical bullion coins or bars, that's your ultimate safe haven. Direct ownership. Then there are gold ETFs, which are very efficient, very liquid, easy to trade. Or you could look at gold mining stocks. They offer leveraged exposure, but definitely come with higher risk.
Got it. Physical, ETFs, or miners. And as we finish this deep dive, what's the one final thought you want to leave people mulling over?
I think the key takeaway is that the structural drivers pushing gold higher, they look like they're here to stay. You have major institutions, JP Morgan, Goldman Sachs, forecasting a plausible path towards $4,000 an ounce by mid-2026. So this isn't just a fleeting market moment. It feels much more like a fundamental, maybe even permanent, shift in the global financial system.